Time now to spotlight the energy sector and what we can expect in the second half of the year. Joining us now for insight is Ben Cook, Portfolio Manager, Hennessy BP Energy Transition Fund. Excuse me, a little bit of a mouthful there. All right, Ben, thank you so much for joining us. Let's talk about some of the price action in the energy sector and equities in particular. You say that energy equities are pricing in a bear case scenario. So what do markets seem to be missing right now? Because it seems to me that you believe that is not an accurate way to price things.
Yeah, first off, good morning, Diane.
Good morning.
Thanks for having me. You know, our view is that the market is pricing in about a $60 WTI crude price into the equities at this current time, although the strip is much higher than that $60 per barrel price. And so our view is that the market is pricing in a worst case scenario. We think it's likely a result of OPEC's returning barrels to the market. Recently, OPEC decided they would accelerate the return of volume production back to the market. So we'll see on the order of 500,000 barrels next month and another 500,000 barrels the following month. By the end of September, we could see the full 2.2 million barrels a day of previous cuts come back to the market, and we think that's weighing on investor sentiment.
So do you think that, so you don't see that as an oversupply issue?
You know, short term, it could be an oversupply. Our base case is, again, for a $60 price through the end of this year, but we do see the gears of recovery starting to turn. And we think there's three reasons for that. We think reduced spare capacity at OPEC, reduced production here in the US and other non-OPEC countries, as well as reduced spending by the global upstream sector. We think ultimately those will all work to move prices higher next year.
Okay, so to move prices higher next year. So through the end of this year, you expect us to land around $60 a barrel. I've seen targets like that, and we've been kind of back in this 65, we're around $68 a barrel now, but
Right.
Back in that range between, it was hovering around 65, which was before that geopolitical risk factor that sent prices higher, and then we went back to the range that we were seeing. What was that, in mid-June, where it was around $60 to $65 a barrel. Let's talk a little bit about some of the companies that you're watching in the space, Exxon Energy, Williams, and Exxon. You like them. They have, you know, Exxon Mobil's up a little more than 5.5% year to date. You've got Williams up more than around 7.5% year to date, which is slightly outperforming the S&P 500. What do you expect in terms of their performance in the second half of this year?
Yeah, we expect continued strong performance from much of the natural gas value chain and the companies that make up that value chain. The integrated business model, you mentioned Exxon. We think even in a muted commodity price environment where oil is $60, $65 per barrel, Exxon, with their integrated business model, has the ability to generate very good earnings and cash flow from their refining business. We're seeing fairly strong demand for refined fuels, and you know, their refining business will generate very good results this quarter. We expect that to continue through the back half of the year. But the natural gas story is very strong, and if you consider the demand tailwinds that we're seeing, not just from LNG export, but the increased power demand for artificial intelligence computing power, we think there's going to be a growing market for natural gas, and we see a lot of ways to win there.
What portion of that, or how big of a driver is AI for that bullish sentiment you have around that gas?
Yeah, that's a great question. You know, from the utilities that we speak with, we see a pretty strong growth rate in load capacity or power generation capacity over the next 5 years. So through the end of the decade, we anticipate about an additional 8 BCF a day of natural gas demand, in addition to the growth that we're seeing from LNG export capacity on a base of about 105 BCF a day. So we're talking about between now and the end of the decade, an additional 5 or 6% in addition to LNG export growth of demand for natural gas for AI power computing.
Okay, one of the things I've talked to different, experts in this area about is, the expectation for growth in energy demand and more and a stronger need for more diversity there. But the biggest, growth story has been about nuclear. Do you see it that way as well?
Yeah, there's clearly policy support for nuclear. I think on a short-term basis, nuclear can supply additional power needs. We're seeing headlines of hyperscalers, Meta, Google, et cetera, approaching power generation companies that have access to mothballed nuclear facilities. To the extent those can be brought on, nuclear will grow. The longer-term outlook, though, is challenging. It doesn't, these nuclear facilities take years and years to go through permitting, regulation, et cetera. So by the end of the decade, we'll be further along, but nuclear won't be a very large part of the power generation supply mix.
Okay, I know you gave me your views on Exxon Mobil, Williams, and Expand Energy. I'm curious to know if you have thoughts on GE Vernova with its positioning within energy.
Yeah, GE Vernova is well positioned to benefit from this power trend. Natural gas, as I mentioned, is going to be a primary beneficiary as the market for natural gas grows into these power generation facilities. GE Vernova is supplying the turbines. There's a multi-year backlog of orders for GE's turbines, and we continue to see strong operating and financial results from that company.
On the policy front, what are you paying attention to there that is supportive of, the bullish trends that you mentioned with regard to nat gas and looking at energy beyond nuclear?
Yeah, in contrast to the Biden administration, obviously we've seen a prioritization of reliability and affordability as opposed to sustainability by the Trump administration. And in that context, we see support for, and even comments from Energy Secretary Wright the other day suggesting that not just natural gas will be a big part of the primary fuel mix for us going forward, but coal and nuclear. So, continued reduction in regulatory impediments, improved permitting, access to federal lands. These things will allow the energy space in the United States to grow and meet the consumption needs going forward.
And do you think, obviously this is kind of a crystal ball question. It feels like geopolitical risk is taken, kind of on the back burner. For the oil story, do you feel like it's just back to focusing on fundamentals?
Fundamentals do reassert themselves after geopolitical risk subsides. There's no doubt about that. But for us, geopolitical risk is a constant, and so there's always some element of the price complex that reflects some supply disruption. I would say there's probably $2 or $3 a barrel in the price today for geopolitical risk, disruption premium. We continue to see missiles fly in the Middle East, conflict from proxies in Yemen. The situation there is far from resolved.
Okay, all right, Ben, thank you so much. We appreciate you joining us today.
You're very welcome. Thank you.
Yeah, you got it. That's Ben Cook, Portfolio Manager of Hennessy BP Energy Transition Fund. Our thanks to Ben.